Okay, welcome everyone. Good evening, everyone. Good evening, Nipun. Good evening, Jyoti, Sapna, Priyanka, Jaspreet, Praneev, Geet, Vedika, Alok. Good evening. Okay, today we have the last session from my end, uh, which is about a very simple topic and equally interesting, is leverages. Okay, so we are looking at this topic of leverages. Let's get started with it. Yeah. Now, where do we get this word leverage as such? Let's try to first understand that aspect. From where has this word leverage come from, right? So this term leverage has actually been obtained from a simple concept of physics. Okay, this has been actually obtained from a simple concept of physics. So how is this coming from by way of physics? Let's try to simply understand that. You guys are aware of this term called as lever, right? You're aware of the term lever, correct? You're aware of the term lever as such. In your school days, probably you might have learned this concept of lever. Now, what is this lever, by the way? As such, what do we mean by the term lever? In your physics, in your school days, I suppose you might have heard this term of lever, right? So just to give you a context, just to give you an example, what is this lever? Remember this type of physics probably in your seventh or eighth, maybe sixth or eighth standard, sixth, seventh or eighth, you might have seen that we have a rod like this, and there is a load over here. There is a fulcrum or the balancing strength over here, and then you have a load over here. Now, to remove this load, we use this sort of lever. Correct? Similarly, if we have a bottle of soft drink, right? Some thumbs up, Pepsi or Coke. To open that, we need a bottle opener. Correct? This is again a type of lever. Just try to understand that if I want to remove this big stone from the road, I essentially need a rod like this because I cannot lift it with my bare hand because that's really difficult for us to do. Right? So this load is going to be lifted only with the help of this fulcrum or only with the help of this lever. Similarly, even the bottle, you cannot open the cap of the soft drink. I'm talking of the glass soft drink, not the one with the plastic in which you open your bare hand. Not that. I'm talking of the cap, the glass bottles which have got the cap on it. Right? You cannot open it only with your bare hands. Just with your fingers, you cannot pull it out. That's fairly, that's almost like next to impossible. So you need a bottle opener for that. Correct? A bottle opener for that. That is again a type of lever. So both these levers, they are essentially the tools by which you are able to perform difficult tasks with great degree of ease. You are in a position to perform difficult tasks with ease. Now, when I say you're going to be able to perform difficult tasks with ease, that simply means you can obtain great results with less efforts. You can actually have a greater degree of results with less effort. Just remember how difficult it would be to remove a stone, remove a big rock which is lying somewhere on the ground. You cannot lift it, or you cannot just move it with your bare hand. You need the help of this lever. Similarly, the bottle cannot be opened with just fingers. You need these cans. You need this bottle opener. This bottle opener or this rod that we use for removing the stone from the ground are basically acting as a levers, in which using them we are able to perform uh, great activities with very simple level of ease. So we are able to perform difficult tasks with ease, or I can say we are able to obtain great results with lesser efforts. This is what we mean by lever. Correct? That's what we mean by lever raise. Now, these levers are essentially used for bringing ease at any activity. Now, similar sort of thing we observe in the financial statements, that the company is going to take less amount of efforts, and in turn it actually gets a greater degree of results. Now let me just show it to you with the help of an example. Okay, so this is what we have the income statement for us. So we have 10,000 units, 10,000 units with the sales value given, variable cost, contribution, fixed cost. Then you have the EBIT figure, then the interest, then we have the profit before tax, profit after tax, number of equity shares, and then the EPS. This is the income statement of XYZ Limited. Now, let us say company increases its efforts by bit. Let us say company increases its effort by some extent, or I say, suppose that the units sold by the company, it increases by 10%. Units sold by the company increases by 10%. Okay. So if that increases by 10%, it means it works out to be 11,000 units. Right? So if it increases by 10%, that means it's 11,000 units. And then the sales, which is selling price per unit of 10 rupees. We can say sales will be, if it's 10, if it's 11,000 units, then the amount of sales will translate to 1,10,000. Correct? And since the variable cost per unit was 4 and we are selling 11,000 units, we'll be able to have a variable cost as 44,000. Contribution is 66,000. Contribution 66,000. Fixed cost 25,000. Right? Because remember, when your units are increasing, when your units are increasing from 10,000 to 11,000, fixed cost is not going to increase. Fixed cost will remain as 25,000 itself. Then EBIT is going to be 41,000 over here. Interest, when your sales is increasing, the banker is not going to ask for a higher interest. The banker is going to still settle for the same agreed amount of interest. That's 15,000. That will make our profit before tax figure as 26,000. Now tax is at the rate of 30%. Tax is at the rate of 30%, which is 26,000 into 30%. That will make it as 7,800. Okay, and then profit after tax figure will be 18,200. Number of equity shares is 1,000. Earnings per share is 18.2. Correct? So now show us the magic, sir. Where is that increase in lesser efforts means greater result? Show us, sir, how is it possible that by just taking 10% effort, we are able to generate more than 10% results? Okay. Fine. So percentage, let's try to understand what is the change in the contribution percentage. By the way, is sales is increased by 10%. From 10,000 it has increased to 11,000, and of course the change that you see in the sales figure, that is also 10% itself. Change that you see in the sales figure, that's also 10%. What about contribution? By what percentage has contribution increased? You see, contribution has increased by 6,000. Correct? Contribution has increased by 6,000. But what percentage is this? So 6,000 divided by 60,000, that is 10%. Correct? Now, if you look at the EBIT figure, have a look. This EBIT has increased by 6,000 itself. But then if you look at the percentage term, so that 6,000 upon 35,000. 6,000 upon 35,000. So the percentage increase is basically 17.14%. Percentage increase is 17.14%. Then PBT has increased from 20,000 to 26,000. So profit before tax, if you look at this number, this has also increased by 6,000. However, this time the percentage is 6,000 of 20,000. That's actually plus 30%. Plus 30%. So from 20,000, it has become 26,000, which is plus 30%. Profit after tax has increased from 14,000 to 18,200. So here the increase is, 4,200. Now that 4,200 as a percentage of 14,000, you'll find that it's 30%. And even the EPS have increased by 4.2. That's also 30%. That's also 30%, right? So what we observe is essentially change in sales is 10%. But the change that we observe in EBIT is 17.14%. And the change that we see finally in EPS or in PAT or in PBT, that is 30%. So units have changed by 10%. That is, the sales have increased by 10%. But resultant impact on EBIT is greater than 10%, and on EPS is even more greater than 10%. Right? That's even more greater than 10%. So can I say company has taken just 10% extra effort? Company has just taken 10% extra effort, and that has actually resulted. That has resulted in 17.14% extra result in EBIT and 30% extra effort in the earnings per share. Okay, so sales has increased by 10%. EBIT has increased by 17.14% and EPS has increased by 30%. Okay, so that's where we see this growth pattern. So 10%, 17.14 and 30%. Right? So that's what we call it as a leverage. Less efforts, but in turn that's giving me more result. Right? Less efforts, but more result. Correct? So now if we talk of leverages, there are three types of leverages that we are talking about. The first case of operating leverage, we say that our efforts are basically sales. And the result that we get is basically the EBIT. So in a sense, what we mean is we want to calculate the operating leverage as what will be the percentage change in EBIT due to a given percentage change in sales. Right? So operating leverage is what will be the percentage change in EBIT due to a percentage change in sales. Right? So if I ask you in the given question, what was the percentage change in EBIT, guys? Tell me. In this example, what was the percentage change in EBIT? By what percentage my EBIT is changing? So 17.1. And by what percentage has sales changed? I have changed it by 10%. So the percentage change in EBIT is actually 17.14% due to a 10% change in sales. So we say that this comes out to be 1.714 times, right? So for 1% change in sales, there will be 1.714% change in EBIT. So this number 1.714 indicates that if you take 1% extra effort, the result that you will see in EBIT is going to be 1.714%. So the sales that we have, this one, this indicates the efforts. And the EBIT that we have, this indicates the result. So 1.714 being the result impact, that is the change in the EBIT, and this change in sales, that was the efforts. That is the case of efforts, right? So this is essentially for 1% change in sales, there will be 1.714% change in the EBIT or the result. Okay, that's one aspect. That's one type of leverage. Now, another leverage is financial leverage. Now, in financial leverage, we say the efforts are actually at EBIT level. Efforts are at EBIT level. Efforts are at EBIT level. Okay. Then the result that we see, we are essentially talking of if EBIT changes by a percentage, what will be the impact on profit after tax or PBT, or even in case of earnings per share. Or to be simply speaking of, we say that result is actually the EPS. Because finally we want to know what is the impact on EPS, right? So essentially, financial leverage formula will be like, sir, what is the percentage change in EPS due to a given percentage change in EBIT? So we saw that EPS was changing by 30%, while EBIT was changing by 17.14%. So that makes it as 1.75 times. So what does this mean? It simply means for 1% change in EBIT, right, there will be for 1% change in EBIT, there will be 1.75% change in the EPS. Or you can also say that same percentage change will observe even in case of PAT and PBT. Okay, so over here, this EBIT figure is essentially the efforts, and the resultant impact on EPS and PAT is result. Okay, so efforts and then the resultant impact is on the result. Right, so that's your financial leverage. So as to how much financial advantage you are getting, right? Then combined leverage is basically over here we say efforts. Combined leverage, in case of combined leverage, efforts are the sales figure. Now we see what is the change in sales that we are looking at, and the result is going to be on the EPS. So it is like connecting sales with EPS. So if you just try to look at what will be the formula of combined leverage, so combined leverage formula is going to be percentage change in EPS due to percentage change in sales. Percentage change in EPS due to percentage change in sales. Now, what is the percentage change in EPS? So it was 30%. And what is the percentage change in sales? 10%, which is 3 times. Right? So here it means for 1% change in sales, there will be, for a 1% change in sales, there will be 3% change in EPS. For a 1% change in sales, there will be 3% change in EPS. So over here, the same context goes that sales indicates the efforts that you are taking, and the result that you see in EPS is the resultant, right? Okay, so these are the 3 types of leverages wherein we have this typical formula of operating leverage, financial leverage, and combined leverage. Right, so these are the 3 formulae: operating leverage, financial leverage, combined leverage. All of these 3 indicates what sort of advantage you are likely to get. What sort of advantage you are likely to get from the financial, by undertaking the leverage. Now, if you just analyze as to why this leverage or advantage is possible, right? So you can see the the reason for that is first the fixed cost, interest. These 2 are the reasons, because contribution changes, but fixed cost remains same. Same way, EBIT changes by some percentage, but the interest being again an interest cost, that remains same. Right? So these leverages indicate to what extent we are able to take advantage of these fixed costs. And one more important thing which you can just verify is the combined leverage is operating leverage multiplied by combined leverage. So operating leverage is 1.714 into combined leverage is 1.75. You'll find that it is coming out to be 3. Some decimals here and there may be there because we haven't considered everything over here, the percentage change, but the formula still holds true. Or even if you just look at it, the multiply operating leverage, you'll say that percentage change in EBIT gets cancelled, and you have percentage change in EPS upon percentage change in sales. So why do we have leverage, by the way, in our books, in our income statement? Why do we see the leverage? Why do we see that there is a typical leverage thing coming up in the question, or in the financial statement, in the income statement? Why do we see the leverage? The reason, as I stated, is the fixed cost number and the interest thing. Reason is fixed cost and the interest. You observe that fixed cost remains same, as well as the interest amount, that also remains same. Correct? So if we say, is leverage good or bad? What would be your answer? Is leverage good or bad? Tell me, guys. As per you, what do you think, that is having leverage in your books good or bad? Is it good? Having leverage in your books, is it good or bad? It's good. Well, my answer would be, sir, it is good as well as bad. Sir, but we see that there is a greater result possible over here. So how can you say that it's bad also? Let me just try to prove it to you with some more numbers. Now, suppose that the sales, instead of increasing by 10%, it decreased by 10%. Suppose it decreased by 10%. So what will be the units? It's going to be 9,000 units. What will be the amount of the sales? Sir, amount of the sales will be now 90,000, right? Then since the amount of the sales is 90,000, variable cost will be 36,000, and contribution will become 54,000. Fixed cost is 25,000. Constant, fixed cost will remain same. Now we have the EBIT as 29,000. Interest will be 15,000, and profit before tax will become 14,000. Now taxes at the rate of 30% will be 4,200, and profit after tax figure will be 9,800. Number of equity shares continues to be remaining 1,000, and the EPS that we get is 9.8. If you just try to look at the numbers, so contribution has reduced by 10% because it has reduced by 6,000 in number terms, minus 6,000. So that's actually minus 6%. Similarly, if you look at the EBIT number, the EBIT has also reduced. EBIT has also reduced by 6,000, but this time the percentage reduction is, sorry, this was 10%, 10% reduction in the contribution, and EBIT, the percentage reduction is over here 17.14%. So what's the impact on EPS? You'll find EPS has reduced by rupees 4.2. That's a reduction of 30%. That's a reduction of 30%. Okay. Now, so can you say over here, sir, 10% reduction in the sales has led to 17.14% reduction in EBIT and 30% reduction in the EPS. Correct? So that's what I said, that, sir, leverage is good as well as bad. It's good for us if we try to take some more efforts. It is bad for us if just reduce your efforts by some percentage. If you reduce your efforts, the result is also going to be reduced by a larger term. Okay, the result is also going to be, in a sense, that it's going to be reduced in a larger number. So it's good as well as bad. Now, what do you say? Something that's good as well as bad. What do you call out that thing which is good as well as bad? Leverage, we say good as well as bad. What is that concept, or what is that thing which you say that it's good as well as bad? So that's actually the term risk. Right? So you guys might have seen the epic uh, web series of Scam 1992, right? Have you guys seen it? Scam 1992, and every finance professional, and even the finance student like you guys, there we have the dialogue, right? Risk hai to ishq hai. It means if there is risk, there's love, right? That's what the dialogue says. Okay, so it's good for us if we are able to use it for our advantage. If you aren't able to use that for our advantage, then it will turn out to be a bad thing. Then it will turn out to be a bad thing, guys. So risk is basically good as well as bad, and that's what we call it as a leverage. And leverage, when we say operating leverage, it's actually a measure of operating risk. Actually, a measure of operating risk, right? Financial leverage. Financial leverage. It was financial risk. And combined leverage is essentially denoting the total risk which the company has undertaken. Okay, so more risk, more return only if it's for your advantage. So we have seen that operating leverage can be calculated by this percentage change in EBIT upon percentage change in sales, and same way it goes for this combined leverage and the financial leverage. Now, having seen these numbers, we would like to know some shortcut formula for leverage, because otherwise every time I have to compute the leverage, so you would ask me to increase the sales by 10% and then see what is the impact on EBIT and all other stuff. I don't want that to happen. So I want to have some shortcut formula for calculation of leverages. Let me just give some shortcut formula to you. Yeah, see guys. Percentage change in EBIT upon percentage change in sales. That's our operating leverage original formula. If I just rewrite this, can I say it is same as percentage change in EBIT upon percentage change in contribution? Correct? Can I say it from the table? Yes. Look at it. The percentage change in sales is same as the percentage change in the contribution. The contribution percentage change is same as that of sales. So we can write it essentially as this formula: percentage change in EBIT upon percentage change in contribution. And this is what we have got from the table. Right? Now, operating leverage, we can say, sir, operating leverage formula, percentage change in EBIT, that's going to be EBIT 1 or new EBIT minus old EBIT, this whole term divided by old EBIT into 100, the whole substance divided by new contribution minus old contribution divided by old contribution into 100. So that it goes off like this, correct? So if you just continue with rewriting this thing, it's actually EBIT, new EBIT minus old EBIT upon old EBIT multiplied with old contribution upon the new contribution minus the old contribution. Now, if you look at this number, EBIT 1 minus EBIT 0, or I guess the new EBIT minus old EBIT, look at over here. What was the new EBIT? 41,000. What was the old EBIT? 35,000. So what was the change? That was 60,000. Similarly, what is the change in the contribution? The amount of change in contribution is also 6,000, right? So here, EBIT 1 minus EBIT 0 was 6,000, and this is also 6,000. Since both of them are same, we can just cancel them, and essentially the formula that is left over for operating leverage is contribution upon the EBIT figure. Contribution upon the EBIT figure. So this is operating leverage, is what we call it as a measure of operating risk. The measure of operating risk. Financial leverage is EBIT upon PBT. This is essentially a measure of financial risk. I'm just giving out the shortcut formula to you so that you can essentially understand that computing leverages is pretty easy. Just as we derive for operating leverage, similarly you can also derive it for financial leverage, and for combined leverage, it's going to be contribution upon profit before tax. Okay, this is a measure of, this is going to be a measure of overall risk. Right? So combined leverage is going to be contribution upon PBT, which is a measure of overall risk. Now, is leverage good? We have answered this yes as well as no. When is it yes? If your sales is supposed to be increasing, and no if you're anticipating that there is going to be a reduction in the sales. So in future, if you are anticipating that the sales are going to go down, then you should say that I should minimize, I should reduce my leverage. Now, can you tell me how can you change your leverage? How can you reduce your leverage, or how can you increase your leverage? Simple, guys. You can do that by working around the fixed cost and the interest. If you are able to reduce your fixed cost, you will be able to reduce your leverage. Because if this number reduces, right? So of course, the impact on the leverage, impact on the subsequent thing is also going to be lower. Your operating leverage will get reduced. If your interest reduces, your financial leverage will get reduced. Okay, so it's good or bad. It all depends on what level of sale are we looking at. Correct? Good. Now, since we have done this formula, we can essentially go for some questions. I'll just give you a minute, guys. You can just download the question sheet from the portal. Download the question sheet from the portal, guys. I have uploaded it. Uploaded it on the portal. You can do some questions on leverages. You can download this question, guys. Come on, get it downloaded, and then we can essentially begin with the solution to these questions also. Yeah, have you downloaded it? Is there? Okay, so without wasting much of time, let's begin with the questions. So let's get started with question number 1, guys. Find out the operating leverage from the following data. Sales is 50,000. Variable cost is 60%. Fixed cost is 12,000. We have to calculate the operating leverage. Sales 50,000, variable cost 60%, fixed cost 12,000. Compute the financial leverage from the following data. Net worth is given as 25 lakh. Debt equity ratio is 3:1. And interest rate is 12%. Operating profit is 20 lakh. Right? So let's try to solve them. Question number 1. Sales is given as 50,000. So to solve this, let us say, let's try to prepare the income statement for this question. Start with sales. Sales of 50,000. From that, we'll reduce the variable cost. The variable cost is given as 60%. Variable cost is given as 60%, which is 30,000. Contribution is 20,000. Less fixed cost is 12,000. And EBIT, earnings before interest and tax, is 8,000. Right? We have this income statement up to EBIT level. By the way, operating leverage has to be calculated from this. Financial leverage will be calculated from this. Okay. First, talking of operating leverage, we can simply calculate the operating leverage as contribution upon EBIT. Contribution on EBIT. Contribution is 20,000 upon EBIT level of 8,000, which is essentially 2.5 times. Operating leverage stands at 2.5 times. Yeah. Now, let's look at the second part of the question, which is compute the financial leverage. This was part A. And now part B will be computing the financial leverage. So the financial leverage, we can compute it by using this debt equity ratio. Question has given us the net worth as net worth is 25 lakh. Right? Net worth is 25 lakh. Debt equity ratio is 3:1. Net worth is 25 lakh. Debt equity ratio is 3:1. So since debt equity ratio is 3:1, we can say debt upon equity or borrowed funds upon owned funds is The ratio is 3:1. So debt we don't know. Equity will be 25 lakh, and therefore debt will be 75 lakh. Okay, debt will be 75 lakh. Okay, so with the debt amount, we can actually go ahead with calculating the financial leverage because operating profit is given as 20 lakh. We have the operating profit or EBIT given to us. Operating profit is 20 lakh. From that, we have to reduce the interest. Correct, guys? So interest is going to be at the rate of 12%. Now this is going to be 12% of 75 lakh. 12% of 75 lakh. 12% of 75 lakhs, which is 9 lakh, right? And then we have a profit before tax figure of 11 lakh. From that, we will reduce the, in fact, tax is not needed because to compute the financial leverage, we can simply do it by a simple formula, right? That's EBIT upon profit before tax. So EBIT figure is this because whenever we say operating profit, understand it to be your EBIT figure. Okay. Fine. So EBIT is 20 lakh upon a profit before tax of 11 lakh. That gives us a financial leverage figure to be 1.8182. And remember, this is always measured in times. All our leverages are measured always in times. Yeah. Do we need to multiply 100? No, you need not multiply it with 100. It is always in times. We are not calculating percentage as such. We are calculating what will be the impact of 1% on the other person. Okay, question 1. It's pretty easy. Let's go for the next question. Question number 2. Go for question number 2. Following details of RST Limited for the year ended 31st March 2006. So operating leverage is 1.4. Combined leverage is 2.8. Fixed cost, excluding interest, is 2.04 lakhs. And we have a sales of 30 lakhs. Debentures, 12% debentures, 21.25 lakhs. Equity share capital of rupees 10 each, 17 lakhs. Okay. So equity share capital is given as 17 lakhs. Income tax rate is 30%. We have to calculate the financial leverage. We have to compute the PV ratio and EPS. If the company belongs to an industry whose asset turnover is 1.5, does it have a high, low asset leverage? And at what level of sales the earnings before interest and tax of the company will be equal to 0? Okay, so these are the certain parameters given and 4 items are to be computed. So let's get started with some basics and then going for some advanced things. So question number 2, the information that the question provides us. First up is about the operating leverage. Operating leverage of 1.4, combined leverage of 2.8, fixed cost is given as 2.04, but using this operating leverage and combined leverage, we can actually compute the financial leverage. Right, guys? Combined leverage is operating leverage multiplied by financial leverage. So combined leverage is 2.8. That's equal to operating leverage of 1.4 multiplied by financial leverage. So finance leverage is 2.8 divided by 1.4. Finance leverage is 2 times. So finance leverage is 2 times, guys. Yeah. So operating leverage 1.4, combined leverage 2.8. So we're getting the financial leverage as 2 times. Okay. Let's try to prepare the income statement from the information given, and let's see if we can calculate some other things, because essentially the first part is answered. What is the financial leverage? We have to answer what will be the PV ratio and what will be the EPS. For that, of course, the income statement needs to be prepared. Income statement starting with sales less variable cost. We have contribution. From that, we will reduce the fixed cost. We have EBIT. From that, we'll reduce the interest. So that we get profit before tax. This divided by number of, well, we have to reduce the tax, right? So that we reduce the tax, we get profit after tax divided by number of equity shares, we get a EPS. Okay. Sales is 30 lakh given to us, right? Sales is given in the question, 30 lakhs. From that, we reduce the variable cost. Variable cost is not given. So, anyways, variable cost is unanswered. Even the contribution remains unanswered. But we can write down the fixed cost, because fixed cost is given as 2 lakh 4,000. Fixed cost is given as 2 lakh 4,000. EBIT is something which we cannot compute, but can we compute the interest? Yes, sir, we can compute interest, because that's 21.25 lakh into 12%. Interest is 21.25 lakhs into 12%. So 21.25 into 12% will be 2,55,000. Then we can't say PBT, we can't say tax, we can't say PAT. Number of equity shares is something that we have. Number of equity shares is 1,70,000. EPS is 1 point. Something that we need to compute yet. So, anyways, we have to fill up this entire thing. Now, how are we going to do that? To begin with, since we know the fixed cost, which is the leverage that revolves around the fixed cost, that's operating leverage, right? Operating leverage is given as 1.4, which is essentially contribution upon EBIT. Contribution upon EBIT. So 1.4 is equal to contribution upon contribution minus fixed cost. So that's 1.4 is equal to contribution upon contribution minus fixed cost is 2 lakh 4,000. Right? So 1.4 is equal to C upon P minus 2,04,000. And if you just try to solve it, 1.4 multiplied by this, it becomes 1.4C is equal to 1.4C minus 2,85,600 equal to C. Then if you just try to solve it further, so that's 1.4C minus C is equal to 2,85,600. 0.4C is 2,85,600 and C will be, if you divide it, that's 7,14,000. Contribution is 7,14,000. Contribution is 7,14,000. So I'll just color it a bit differently. 7,14,000. Now, once we have this contribution 7,14,000, can we compute the PV ratio? Because what's the formula for PV ratio? By the way, PVR over doesn't mean the film theater, and we're talking of the PV ratio. I'll just write it as PV ratio. Otherwise, some dumb fellows will say, sir, what is this PVR? What is PV ratio? Price volume ratio, right? So that's computed as contribution upon sales. PV ratio is contribution upon sales. That is equal to contribution upon sales. We say that the contribution amount is 7,14,000 upon sales figure is 30 lakh. Right? So this works out to be 23.8% as the PV ratio. 23.8% is the PV ratio. Now, what about the variable cost? Can we compute this? Yes, we can, right? Because that's just the reverse calculation. So let's try to fill it up as much as possible. Variable cost is essentially going to be 30 lakh minus 7.14 lakhs, right? So that's 22 lakh 86,000. Then fixed cost is done. We can definitely get the EBIT figure 7,14,000 minus 2,04,000. So 7,14,000 minus 2,04,000 is 5,10,000. And then from that, when you subtract interest, we get a profit before tax figure of 2,55,000. And the tax is like, I think the tax percentage is given to us, which is it given? Tax percentage, yeah, 30% is the tax rate given to us. So applying 30% on 2,55,000, that makes it as 76,500, and PAT is 1,78,500 divided by the number of equity shares, 1,70,000. EPS is 1.05. Your EPS now. What all have we got? We have computed the PV ratio, computed the EPS, financial ratio is done. Now, the third part of the question, it says, if the company belongs to an industry whose asset turnover is 1.5, does it have a high or low assets leverage? So in the industry, the industry to which this company belongs, there the asset turnover is 1.5. Now, what does this 1.5 mean? It means with the asset of 1 rupee, they are able to generate 1.5 rupee sales. Okay, with 1 rupee asset, by investing 1 rupee of asset, they're able to generate 1.5 sales. And the question says, is this company having a high or low assets leverage or asset turnover? So first of all, we need to work on that asset turnover. Sir, asset turnover, say asset turnover, as the name says, that is sales upon assets. Asset turnover is sales upon assets, which is 30 lakh divided by assets of 17 lakh, or I'll not say that as assets as such, because see, this asset is going to be equal to the liabilities. Assets is going to be equal to liabilities. So that is essentially equity plus debt. Do we have the value of equity and debt? Do we have the value of equity and debt in our books? Yes. 17 lakh. Right? 17 lakh. Over here, we have this. Looking at the question. Yeah. Debentures of 21.25 and 17 lakh equity shares. We have equity of 17 lakhs and 21.25 lakhs of liabilities. And sales that we have is 30 lakh. That is 30 lakh divided by 38.25 lakh. So that works out to be 0.78 times. So what is the industry performance? Industry asset turnover is actually 1.5, which means rupees 1 asset leads to rupees 1.5 sales. Whereas in our given company, what we find is it is 0.78, which means by investing 1 rupee in asset leads to rupees 0.78 sales. 1 rupee asset leads to rupees 0.78 sales. So what we can say is low asset turnover. Right? The company is having low asset turnover as compared to industry. As compared to industry, this is having a low asset turnover. Right? So low asset turnover. Then the fourth part, at what level of sales will EBT, that is profit before tax, will be equal to 0? Question is asking at what level of sales are we going to have profit before tax of the company equal to 0. Okay, so how are we going to look at it? See, we'll start with, of course, the part 4 is starting with sales. Sales was 30 lakh given to us. Less we had the variable cost. That gave me the contribution, right? From that, we'll subtract the fixed cost. And then you get the EBIT. From EBIT, we subtract the interest. We get EBIT. And variable cost was given, we in fact calculated it as 22 lakh 86,000, right? Remember over here, 22 lakh 86,000. And we got the variable cost as the contribution is 7 lakh 14,000. Fixed cost is 2 lakh 4,000. EBIT figure is 5,10,000. Interest is 2,55,000. We get a PBT also as 2,55,000. Right? This is what we had over here. Now, with this, profit before tax, they want us the profit before tax number to be 0. Profit before tax number to be 0. And they're asking us what should be the resultant sales. If PBT is supposed to be 0, what will be the resultant sales? Without much exception, we can say interest is going to be remaining 2,55,000 itself. Fixed cost will remain as it is 2,04,000, right? So we have to do the backward calculation and obtain the value of sale. Let's do the backward calculation, and what we find is that if you want your PBT to be 0 and your interest cost is 2,55,000, essentially EBIT should be also 2,55,000. And doing the backward calculation, contribution will become 4,59,000. And then doing a cross multiplication, like this is 100, and we have seen the PV ratio. PV ratio was 23.8, which is a percentage of contribution on the sales. That's 23.8%. It is 23.8%. And simple cross multiplication, you should get this sales figure as 19,28,570. That's the fourth part. Are we able to get this? Let me see if there are any queries. Up to how many decimals? You can have it up to 2. Okay. You need to write in terms of financial leverage and combined leverage as times, because they are measured in so many times itself. Varsha, the assignment is it's just uploaded today. The question sheet will find in the today's upload itself. Okay, PVR, price volume ratio. Earnings per share is fine. Okay, no such queries as such. Fixed cost is 2,04,000. I've also taken fixed cost as 2,04,000. Even the question has stated 2,04,000, 2.04 lakhs. Right? Okay. That was about this question number 2. Now, let's start with the next question 3. Now, in regards to question 3, there are 3 companies given to us. From the following income statement, A, B, and C, briefly comment on each company's performance. So company A, B, C, we have been given the financial leverage, we have been given the interest, we have been given the operating leverage, we have been given variable cost as a percentage to sales, and income tax rate is also given. Right? So these 3 companies have been given to us. What we'll do is I'll solve for company A. For B and C, I want you to try them during the break. I want you to try the B and C for that break. So probably we'll have a 5 minutes longer break today because we need to solve this B and C during the break, and then we'll discuss the answers. But I'll solve this question one for you. So first I'll need to prepare the income statement, and then for A, and then think of B and C. For company A, let's begin. Company A, we have sales figure. We need the variable cost to get the contribution less fixed cost. We have EBIT less interest, profit before tax. From that we subtract the tax, and then we have the PAT. Now, based on the numbers, we have only one figure available to us, which is the interest being 200. So it's only the interest which is given to us 200. Right? Rest everything is to be computed. We will begin with financial leverage. Financial leverage is given to us as 3. Right? So financial leverage is 3, which means this is essentially EBIT upon PBT. That's equal to 3. Therefore, EBIT upon EBIT minus interest is 3. So I'll just write the EBIT as E. E upon E minus 200 is equal to 3. Therefore, E will be equal to 3E minus 600. And on solving this, should get it as 600 equal to, just rearranging the terms, 600 is equal to 3E minus E. So 2 times of EBIT is 600. 600 by 2 is 300. So I've got the EBIT as 300, and by reverse calculation, we can simply say that PBT will be 100. And what's the tax rate given, guys? Tax rate is 45%. So 45 rupee will be the tax, and 55 will be the PAT. Then we can use operating leverage for the remaining portion, which is given to us as operating leverage is 4. So operating leverage is 4. Therefore, contribution upon EBIT is 4. We know contribution upon EBIT. EBIT is computed earnings before interest and tax is 300. That's 4. And therefore, we say contribution is 1200. We get the contribution as 1200. So the differential figure over here, fixed cost, will be 900. That's the balancing figure, right? Then in the question, you find that variable cost as a percentage of sales is given. 66 2 by 3. Right? So 66 2 by 3 percent is essentially 2/3. So if sales is 1, variable cost is basically 2/3 and contribution is 1/3. You can do the reverse cross multiplication. We get the variable cost as 2,400 and the sales is 3,600. We have this income statement. Are we all able to get it? Fixed cost is always exclusive of interest, true. We have difference due to decimals. There won't be much impact due to decimals. You can follow a standard of taking up to 2 decimals. So can we do for company B and C on the similar lines, guys? I have done it for company A. You can take a screenshot or you might have already downloaded the file. Can you do it for for company B and C, right? Do it for company B and C. As answer, you have to give me the figures of essentially the sales. What is the sales? 66 2/3. That's a mixed fraction. 66 2/3. Right? So mixed fraction percentage. That's like 2/3 of the total, right? Okay. So complete this part. Complete this for B and C during the break. We'll take a break of probably 15 minutes. And during that break, you can just try to solve these two, and then I'll verify the answers with the help of sales. Okay, so let's take a break, guys, of 15 minutes. Out of that, just take a break of 5 minutes. Rest 10 minutes you should do. You should use it for solving B and C. Okay, let's take a break, guys. Okay, welcome back, guys. After the break, did we get the answers? Did we get the answers? So sales of company B is 8,000 and of company C is 12,000. Correct. You're correct, guys. Sales of company B and C 8,000 and 12,000. Perfect. Now that was question number 3. Now let's go ahead with the next, which is question number 4. Now, question number 4. The operating income of textile firm amounts to 1,86,000. It pays 50% tax on its income. Its capital structure consists of following: 14% debentures worth 5 lakh, 15% preference shares 1 lakh, equity share 4 lakh. Determine the firm's EPS. That's the very first part. Second part is determine the percentage change in EPS associated with 30% change, both increase and decrease in EBIT. Determine the degree of financial leverage at current level of EBIT. What additional data do you need to compute operating as well as combined leverage? Right. So based on the information, let's start with the operating income. So we have this operating income, which is EBIT of 1,86,000 given to us. Now we know, of course, from this we will reduce the interest. We get profit before tax. From that we subtract the tax. We get profit after tax. From that we subtract the preference dividend. We get net profit for equity shareholders. Divide this with number of equity shares and we get the EPS. Now why are we doing this? Because why are we doing this net profit for equity shareholders preference dividend? Because the company has preference shares in its capital structure. Let's continue. So now EBIT is 1,86,000. The amount of interest will be 14% debentures, 5 lakh into 14% debentures. So interest is going to be 5 lakh multiplied by 14% is 70,000, and this is 1,16,000 PBT. Now less tax, it is 50% of the tax. So tax amount will be 58,000 and profit after tax is 58,000. Preference dividend is 15,000. Net profit for equity shareholders is 43,000. Number of equity shares as given in the question, 4,000. And earnings per share will work out to be 10.75. So we have answered the first question, which is determine the firm's EPS. That's done. Second is determine the percentage change in EPS associated with 30% change, that is increase as well as decrease in EBIT. If my EBIT increases by 30% or decreases by 30%, what is the resultant impact? on the EPS. First up, we will say if EBIT increases by 30%, a new EBIT after 30% increase, it's going to be 2,41,800 less interest of 70,000. We have a profit before tax as 1,71,800. Now tax, as it is stated to be 50%, this time over here tax will be 85,900. PAT is also 85,900. Preference dividend is 15,000 and net profit for equity shareholder is 70,900. Dividing it by the number of shares, 4,000. Earnings per share is basically 17.725. Now, if the EBIT is reducing by 30%, if we take the reduction in EBIT by 30%, the EBIT is going to be like 1,86,000 multiplied by 70%, right? So that's 1,30,200. Interest will be remaining same as 70,000, and we get the profit before tax figure as 60,200. Now, the tax figure is also going to be 50%, so that works out to be 30,100, and PAT is also going to be same 30,100. Preference dividend, we will continue to have it as same 15,000, right? And net profit for equity shareholder is 15,100. Dividing it by number of equity shares 4,000, that's 3.775. Earnings per share is 3.775. So what's the change in EPS that we observe? What's the change in EPS? Here, EPS has changed by 17.725 minus 10.75 divided by 10.75. 17.725 minus 10.75 divided by 10.75, which is the change is 64.88%. And of course, this side you will find that it is 3.775 minus 10.75 divided by 10.75, which is minus 64.88%. Minus 64.88%. Okay. Now, if you look at this terms, 64.88 minus 64.88%, that's the percentage change in EPS. If I ask you, how do we compute the financial leverage over here? Now, financial leverage is simply percentage change in EPS upon percentage change in EBIT. So that is 64.88% divided by 30%, which is 2.16 times. So financial leverage is 2.16 times. Okay. Now, one prominent way, we have seen the shortcut also. Financial leverage, we had the shortcut as EBIT upon PBT. So if we just try to work out with that number over here, EBIT being 86,000 and PBT being 1,16,000. You'll get it as 1,86,000 divided by 116,000 as 1.6034, which is definitely the incorrect financial leverage. Because this number is not matching with our fundamentally correct answer. Fundamentally, we say that change in EPS due to change in EBIT is the correct way of computing the financial leverage, which is 2.16 times. Whereas this financial leverage that we compute over here by shortcut is 1.60. This is incorrect. So is there any shortcut for this type of thing? Now, first we need to identify why is it not matching? Because if you look into the income statement, there is one more fixed cost creeping in, and that is the preference dividend. And when I take PBT, the impact of preference dividend is not taken off. So if I really want to know what will be the financial leverage, the formula is EBIT upon profit before tax minus preference dividend upon 1 minus tax. EBIT upon PBT minus preference dividend upon 1 minus tax. EBIT is 1,86,000 upon PBT is 1,16,000 minus preference dividend is 15,000 divided by 1 minus 0.5, which is essentially 1,86,000 divided by 1,16,000 minus 30,000. Now, if you compute it, you will get it as 2.16 times. Correct. So financial leverage is 2.16. Correct. And this 1.6034 is the incorrect form. Okay. That's our financial leverage. Financial leverage is 2.16. So remember, whenever you have a preference dividend coming up in your capital structure, you need to actually use this formula and not the earlier one. Okay. In case of financial leverage, for a question which has got preference dividend, you need to use this revised formula. Are we clear, guys, with this? Are we good with this? Yeah. Fine. So that's our financial leverage. That's the financial leverage term. Now, and in the question, it asks determine the degree of financial leverage. That is done. What additional data do you need to compute operating as well as combined leverage? Can you tell me, guys, what is the additional data that we need? What additional number do we need for computing the operating or combined leverage? Because they have given us data from EBIT onwards. They have given us the data from EBIT onwards. So if I want to compute operating leverage or finance or the combined leverage, what additional data do we need? Of course, the additional data that we need is, sir, additionally, they should give us the contribution or fixed cost. We can say additional data required for operating leverage or combined leverage is you should know what is the amount of contribution, or you should be at least be knowing the fixed cost, right? Contribution or fixed cost. So even if we want to compute the combined leverage, guys, and we have the financial leverage derived by preference dividend, even in case of combined leverage, the denominator is going to be PBT minus preference dividend upon 1 minus P. Right? Additional information, we need contribution or fixed cost that will be sufficient enough to help us in the calculation of the operating leverage or combined leverage. That's question number 4. Right, that's the question number 4 for us. I hope this is clear to us. Now we can go ahead with question number 6. Not 6 basically. Let's try to solve question number 5. Question 5. Calculate the operating leverage, financial leverage, and combined leverage from the following data under situation 1 and 2 and financial plan A and B. We have installed capacity as 4,000 units. Production and sales is happening to the extent of 75%. Selling price is 30, variable cost is 15. Fixed cost under situation 1 is 15,000 and under situation 2 it is 20,000. And capital structure wise, we have the financial plans. We have the financial plans as equity and debt in 10,000, 10,000, which is 20,000 in total. And for B, it is 15,000 and 5,000. So we have to compute under 4 different things. We have to compute it for situation 1 and 2 and financial plan A and B. We have to actually create a table comprising of 4 different columns. Let me just have it as 4 different columns. Okay, so we say particulars, so first thing is situation 1 and plan A. We talk of plan A. Situation 1 in first case and situation 2 in second case. Then plan B, which is situation 1 and situation 2. Okay. So under situation 1, what we have is different is the fixed cost, and under plans we have the different debt equity thing. Okay. So let me just write down the data, the table. Equity, debt, and then total. Equity is 10,000. Debt is 10,000. Total is 20,000. Then, since second column is also for plan, debt equity amounts will be remaining same. For plan B, it is 15,000 and 5,000. 15,000, 5,000, so totaling up to 20,000. 15,000, 5,000, totaling up to 20,000. Okay. Now, after this, debt and equity, since there are situation 1, so that situation 1 and 2 is actually determining the amount of fixed cost. The fixed cost is 15,000 in situation 1 and 20,000 in situation 2. 15,000, and 20,000. Okay. Now, with this basic information, we can begin with the sale. Remember, the sale date going is undertaken at 75% of the capacity. The units that are being sold is actually 3,000. Units are 3,000. Of course, with that, the sales figure can be determined. From that, we will reduce the variable cost. So we get the contribution less fixed cost. So we get profit before tax less tax. Sorry, this is going to be EBIT, right? We have EBIT. From that, we will reduce the interest. So we get profit before tax. Yes, we anyways want to compute the leverages. So up to PBT is also fine. Now, sales is going to be at a price of 30 per unit. So 30 into 3,000. 30 into 3,000. That will be 90,000. The sales figure is 90,000. Variable cost is 15 per unit. Variable cost is 15 per unit. So that means this is 45,000. Right? And from sales, when we subtract the variable cost, we get the contribution as 45,000. Now the changes happen from here because fixed cost in this case, this was situation 1. So that's 15,000. Here the fixed cost is 20,000. Here fixed cost is 15,000. And here we have the fixed cost as 20,000. We get the EBIT, earnings before interest and tax, as 30,000, 25,000, 30,000, and 25,000. Interest will be on the basis of the amount of debt they have and the rate of interest. So debt is 20% rate. So 20% of 10,000 is 2,000. Here it is 2,000. Then we have 1,000, the last cases. And so we have the profit before tax figures. The profit before tax is 28,000, 23,000, 29,000, and 24,000. Now, we can get the operating leverage, financial leverage, and the combined leverage. Operating leverage, financial leverage, and the combined leverage. Operating leverage will be, as per our computation, it is contribution upon EBIT. Financial leverage is EBIT upon PBT. And finally, combined leverage is contribution upon PBT. Contribution upon EBIT. Contribution upon EBIT is going to be the operating leverage. So let's compute the operating leverage numbers first. Operating leverage numbers are basically 45,000 contribution divided by EBIT of 30,000. That's 1.5. The second case, operating leverage is 45,000 divided by 25,000 is 1.8. Is also 1.5 and 1.8. EBIT upon PBT is 50,000 divided by 28,000. 1.07. The second scenario, it is 25,000 divided by 23,000 is 1.09. The third scenario, that's 50,000 divided by 29,000, which is 1.03. And last, it is 25 divided by 24, which is 1.04. And then the combined leverage will be 45,000 divided by 28,000. Is 1.607 or 1.61. Then next is 45 contribution divided by PBT of 23, which is 1.96. Contribution is 45 divided by PBT of 29, 1.55. And finally, contribution of 45 divided by PBT of 24, 1.87. These are the four different cases for multiple leverages. Are we all getting these numbers, everyone? Yes, got it, guys. Easy. It's a very jolly chapter. It's a very easy chapter to deal with. You should be able to get full marks if any question comes from this chapter. Yep. I hope we are done. Yes. Fine. So we can get started with question number 7. Let's do question number 7. Let's do question number 7, guys. Come on. You can take question 6 as homework. That's very easy. Question 7. What's the weightage of this chapter? There's no weightage as such in ICI, guys. We don't follow any typical board paper pattern that there should be weightage. The entire subject is quite relevant. You have to learn the entire subject. Don't follow the path of, keeping some chapters in option or topics in option. Because you never know that question from that chapter itself may be of great weightage. And it may cost you an attempt, right? Never do that. Never keep any typical chapter as such in option. Okay, and don't look for any weightage because all the chapters are equally important. You never know which chapter is going to catch you what weightage. So question 7, guys, let's begin. Question number 7. A firm has a sales of 75 lakh. Variable cost is 56% and fixed cost is 6 lakh. Sales is given, variable cost is given, fixed cost is given as 6 lakh. It has a debt of 45 lakh at 9% and equity of 55 lakh. You are required to interpret the firm's ROI, which is return on investment. Okay. Then, does it have a favorable financial leverage? If the firm belongs to an industry whose capital turnover is 3, is it having a high or low capital turnover? Operating, financial, and combined leverage of the firm. And if the sales increases by 10%, by what percentage EBIT will increase? At what level of sales the EBT of the firm, or against the profit before tax of the firm, will be equal to 0? If EBIT increases by 20%, by what percentage EBT will increase? Okay, so let's try to first draft this income statement for this. Then we can answer each of the sub questions one by one. First, let's begin with sales. So we have a sales of 75 lakh. From that, we are going to reduce the variable cost as 56%. Variable cost is 56%. So at the rate of 56%, what's the variable cost going to be? 75 into 56% is 42 lakh. Then we have the contribution. Contribution as 33 lakh less fixed cost. The company has a fixed cost of 6 lakh. This fixed cost of 6 lakh is going to make EBIT as 27 lakh. From that, we subtract the interest of 4 lakh 5,000. How do you get the 4 lakh 5,000? So that's 45 lakh into 9%. We get a profit before tax as 22 lakh 95. Right? So talking of the first thing that the question is asking us, firm's ROI or return on investment. Return on investment will be earnings before interest and tax upon total capital employed into 100. So earnings before interest and tax, that stands as 27 lakh. Right? Now, how do we get the total capital employed? By the way, this return on investment is actually EBIT upon equity plus debt. And what's the amount of equity and debt? Into the question you find equity is 55 lakh, debt is 45 lakh. This is 45 lakh plus 55 lakh. 45 lakh plus 55 lakh into 100 is essentially 27% is the return on investment. Let's answer the second part of it. Second part asks, does it have favorable financial leverage? Now, whether the financial leverage is favorable or not, we need to look at first the return on investment, which is 27%, and the rate of interest on debt. The rate of interest on debt is 9%. Return on investment is 27%. Rate of interest on debt is 9%. If we just compare these two, return on investment is 27% and rate of interest on debt is 9%, right? Return on investment is 27%, return on investment, return of interest on debt is 9%. So we find that this is a greater figure, right? It means you're getting the funds from the market in the form of debt at 9% rate, and you're actually investing it at 27%. They're getting the funds at 9% and investing it at 27%. So it is quite obvious that your return on investment is greater than rate of interest on debt, right? So therefore, it indicates that you have a favorable financial leverage because you're raising funds at a lower cost and you're investing at a higher rate. Getting the funds at 9% and investing it at 27%, that is definitely a good thing, right? That's definitely a good thing because you're getting funds at a cheaper rate and investing it at a higher rate. That provides you a better leverage. Third, the third point that the question asks is, if a company belongs to an industry whose capital turnover is 3, does it have a high or low capital turnover? Now, capital turnover is basically computed as sales upon capital. Sales upon capital. So sales is 75 lakh upon capital that they have employed is 1 lakh, or sorry, 1 crore. That's 0.75 times. Now, in the industry, capital turnover is 3 times. Industry capital turnover is 3 times. And in case of our company, it is 0.75. Now, what does this 3 times indicate? So, this 3 times indicate ₹1 invested to generate ₹3 sales. Whereas what this company is doing is, for ₹1 invested, the sales is just ₹0.75. So basically, we can say the company has no capital turnover. The company has a lower capital turnover, right? Let's say this simply indicates that the company is having a low capital turnover. Now, we have to compute the operating financial combined leverage for the firm. That's again very simple. Operating leverage, as the formula says, contribution upon EBIT. Financial leverage is EBIT upon PBT, and combined leverage is contribution upon PBT. What's the contribution given in the question? What we have computed? Contribution is 33 lakh. Contribution is 33 lakh divided by a EBIT of 27 lakh. That gives us operating leverage of 1.22 times. Financial leverage is EBIT of 27 lakh divided by 22 lakh 95,000. That was the PBT. 22 lakh 95,000. That means it's 1.1765. And then combined leverage is 33 lakh, which is the contribution, divided by a PBT of 22 lakh 95,000. 33 lakh divided by 22.95. That makes me 1.4379. Easy. That's the fourth part of the question. Then the fifth part. If the sales is increased by 10%, by what percentage EBIT will increase? Now tell me which is the leverage that connects sales with EBIT. This is the leverage that connects sales with EBIT. This is the leverage that connects sales with EBIT. Can I say operating leverage? Because operating leverage indicated what will be the percentage change in EBIT. What is the percentage change in EBIT due to a given percentage change in sales? Right? So operating leverage is percentage change in EBIT upon percentage change in sales. So the operating leverage, we have computed it as 1.22 times. Now the question says that there is a 10% increase in sales. Basically, percentage change in EBIT upon the percentage change in sales is 10%, equal to 1.22. Percentage change in EBIT will be basically 12.22%. Right? Now, sixth part of the question. At what level of sales the EBIT of the firm will equal to 0? At what level of sales EBIT of the firm, the EBT or profit before tax of the firm will be equal to 0? So we have to do the reverse calculation basically. Sales less variable cost will give us contribution less fixed cost will give you EBIT less interest will give you PBT. Now they want us to calculate the sales level at which sales is going, or I can say PBT is going to be 0. So if PBT is going to be 0, I need to obviously consider the interest and the fixed cost thing. So interest and fixed cost. Fixed cost is 6 lakh, interest is 4 lakh 5,000. Fixed cost is 6 lakh and interest is 4 lakh 5,000. You can do the reverse calculation, the thing to get the sales figure. So let's do the reverse calculation. We do the reverse calculation, sir. EBIT should be 4 lakh 5,000 itself. And if that is supposed to be 4 lakh 5,000, then the contribution is supposed to be 10 lakh 5,000. Now, what about the variable cost and sales? What's the ratio given to us? Where the given variable cost is 56%. It means if your sales is 100, variable cost is 56, and contribution is 44. We do the reverse calculation or just a cross multiplication. So say 10 lakh 5,000 into 100 divided by 44. This works out to be 22 lakh 84,091 as the sales figure. This is the sales figure at which your PBT is going to be 0. 22 lakh 84,091. Perfect. Then finally the seventh point over here. If EBIT increases at 20%, by what percentage PBT will change? So what is that leverage which connects your EBIT with profit before tax? That is basically the financial leverage financial leverage is percentage change in profit before tax due to some percentage change in EBIT. Now, they have given this, or we have computed the financial leverage number to be 1.1765. 1.1765, and percentage change in profit before tax upon percentage change in EBIT is given in the question to be 20%, is 1.1765. So what's the percentage change in profit before tax? Just multiply it. That should be 23.53%. Okay. So Muhammad Aslam is asking, I got the ratio as 1.4213. Combined leverage. Combined leverage, if you would have multiplied this, then you would have got that probably round of answer, but never do that multiplication if you have the information of contribution and PBT. If you're having the information of contribution and PBT, use that information to get it, because this 1.22 and 1.1765, these are rounded figures, so don't multiply them. Otherwise, you'll get a rounded answer and you may not get full marks for it. Okay. Now, let me see if there are any other queries. No such queries as such. Are we able to follow this question, guys, as well as this chapter till now? Are we able to follow this chapter? Very easy chapter, guys. Nothing difficult. Correct? Or is anyone finding this difficult? This shouldn't be the case, because that's very easy as such. All clear? Okay, Janish is asking how sales came 22 lakh. Janish, we just did the reverse calculation over here. Profit before tax as 0. Interest and fixed cost was given. Interest was 4,05,000. Fixed cost was 6 lakh. So we did the reverse calculation. If PBT is 0, then EBIT is 4,05,000. Right? And then again doing the reverse calculation, contribution will be 10,05,000. And they have given the variable cost ratio as 56%. So if 100 is your sale, 56 will be the variable cost and contribution will be 44. So you can just do the cross multiplication to get the sales figure. Okay, Pranev is asking why we don't consider the percentage change in EBIT, which we have calculated in 0.5. Percentage change in EBIT. Yeah, you can do that, but again, you will get a rounded answer in that case. Okay. The answers are, you'll get this, you can get this 12.22%, but the answer will be a rounded figure. So I would advise not to use this percentage change in EBIT. Rather, you should be solving it in this full form. Okay, so are we good till now, everyone? So we are done. The chapter, the remaining questions, you can solve them as homework, as a practice. I'll be uploading their solutions at this PDF file also. I've uploaded all the remaining PDF files on the portal. You can download them. this PDF file which you have created today, that I'll be uploading today after the lecture. So now, one thing, when it comes to scoring in FM, you might have seen the last attempt paper. You should be really quick in solving it and understanding the questions. The only way to solve is, getting clear with the concepts. You should be crystal clear with the concept. What does those concept mean? What calculations are we supposed to perform? As soon as you see the question, you should have a model answer in your mind, and then only you should go ahead with the solution. Otherwise, you will just keep on wandering here and there. So theoretical chapters also need to be given due weightage so that you don't miss your marks on that part. Practical chapters, you can go through the study material, you can go through the past papers, you can go through the revision test papers, mock test papers for understanding what type of questions are expected and what type of answers are basically expected from. Okay. Uh, uh, as of now, we are in the month of February and we have like March, April, couple of months to study. Ideally, if you are at home doing, you're focused only on study, per day at least you should target to study 12 to 15 hours. Productive should be 12 hours. You keep a target of 15, but productive hours of study should be 12. Okay. So, and before exams, make sure you have read the topics, read the subject at least, 3 times. That's the general rule that we, as a student, I used to do. So at least have 3 readings of each theory subject at least. And for practical also, you should have gone through the question you have done in a class 3 times, and also in combination with the uh, revision test paper MTP question. Okay. With that thing, let me just call it a day from my end. Let me just put this chapter as well as my session to an end. Let's stop here day, for the day and for the entire session as well as guys. We'll probably uh, be meeting somewhere, some part of our life, maybe. Yeah. So good night, guys. Wish you happy health and also maintain good health before your exam. Don't play with it because if your health is good, then only you can go ahead with the exams. Do take care of your health and prepare well for your exams. All the best for your exams, guys. Till then, bye bye and take care.